All right, guys, welcome back, all my real dealers, and thank you so much for joining me for another amazing episode of Real Deal Meetup on Periscope TV. Of course, it's your girl Queen here. All right, hey Ish, how are you? And thank you everyone who is joining in. I see Big Bro Realty. I like that, Big Bro Realty. Rent Page just joined. Thank you so much, guys. Hi Ish. So for everyone actually who was there last Saturday at our meetup, big thank you from Charles Blair, the mad scientist himself, and the Real Deal community. Bill Fell tore the house down, and I see Chameleon just joined in. Hey Chameleon. Bill Fell tore the house down. He did an amazing job. Everyone left there, their minds were super swollen with all this information. Like it was crazy. But for all of you who don't know, this is the Real Deal Meetup. We're actually the third largest real estate meetup in the nation, so that is the United States. So third largest. So if you go onto therealdealmeetup.com, if you're a fix and flipper, if you're a note buyer, if you are a wholesaler, a landlord, whatever the case may be, Real Deal Meetup, I mean, we're producing so much out of that group. It's great networking. So go on to therealdealmeetup.com and meet some more people. And I believe Tony just joined in. Hey Tony. All right, so guys, for today's episode, you got to give all the hearts possible. So how do you heart it up? You double tap on the screen, and then that's how the hearts start flowing. So I wanted to make this a little interesting. Okay, hi Stylish. I wanted to make this very interesting because this topic can get boring when you have that person there with the suit and tie on and they just blab to you about accounting stuff that you don't want to hear about. But for anyone who's investing, even if you're not investing in real estate, this is very important. I got into my own hiccups with taxes before and got into some trouble. I'm just gonna leave it there. Your girl's not in jail, so nothing crazy happened. But today we're gonna be talking about the little tricks and tools that you could do to keep some more money inside of your pocket for the upcoming tax season. And Mike Grams just joined. Thank you so much, Mike Grams. And for all my Real Deal members, make sure you put an R in the comment box. Also, if you have any questions while we're doing the broadcast, make sure that you type the questions in while I'm talking so I can be sure to ask them. Yes, Real Deal member. All right, so I'm gonna go ahead. We have Trevor here of VBS, and he is actually owner and CEO of the company. Truly amazing guy. So we're going to get the questions started. So everybody stay in tune. And let's get that out of here. Hey Trevor.
How you doing?
How you doing?
Good, very good.
All right, awesome. Well, thank you so much for joining us today. Okay. I know it's a little hot out here, but we
it's all right.
We appreciate you. All right, so cool. First off, we just want to get like a little bit in terms of background. I told everybody this isn't like just a regular, I have an accountant here on the show and we're going to be all boring and stuff. Like you actually invest in real estate yourself too. So just a bit of background about who you are and why you're even qualified to do this broadcast today.
I have obviously a degree accountant, went to Boston College, football scholarship, and ever since I got out, I've been doing accounting. Started off with PricewaterhouseCoopers in New York City, and been dealing with other firms, 2 other large regional firms in Maryland after that. And then I went into business for myself. Started out having a restaurant, then I got into property management accounting.
Wow, okay.
Ran a company down in Lanham for a while doing property management, and then started my own consulting practice called Valuable Business Solutions, and we dealt with tax compliance, personal and also business taxes, and also consulting services. And from that standpoint, the majority of my clients are either real estate professionals or real estate developers.
Gotcha.
And just all different types of clients from different backgrounds. So I use my entrepreneurial background. Also, my father was heavily invested in real estate. He was also a tax accountant.
Okay.
So that's originally how I got into accounting, was watching my father deal with all of his clients, and then I got in real estate, watching my father and my grandmother buy real estate.
Gotcha.
Whether it was in New York City or also in Syracuse, where I'm originally from.
Okay, cool. So how'd you end up in Maryland?
10 years ago, it was something on my radar.
Okay.
And I was ready to get out of New York City.
Okay.
And looked up a couple places on the Northeast. It was either Maryland or DC. And they said Baltimore was very favorable to small businesses.
Yeah.
And I was trying to get a couple things started in New York City, but rent prices are crazy.
Yeah.
Up there. So Maryland just seemed like a good fit.
Gotcha.
And the culture and the people down here just really fit me. So I kind of hit the ground running within a year being down here. I had a restaurant open. It was just a good fit for me.
Cool.
And the opportunities aren't that hard to get into down here.
It really isn't. And no shade to anybody. You know, we're actually both New Yorkers on the line right now, kind of dominating Maryland. No offense, but yeah, Maryland is a good place to get your business off and jumping. Okay, awesome. So now, since you actually been involved with real estate, like your dad was involved with real estate, and then you also started with the property management as well. So in your opinion, what would you say is like the number one mistake? And if this is anybody on the line, just clench yourself because it happens sometimes. What do you see as the number one mistake in terms of real estate investors?
The number one mistake from an operational perspective is I feel like a lot of real estate professionals and real estate investors are not organized. They see real estate as something that they want to do, but when it comes down to having their business in place and taking the time to get organized, they think, okay, just because I can purchase something or I have the capital or I have the means to get involved in this profession or in this industry, that's where it ends.
Right.
But no, that's just absolutely the beginning.
Right.
The real work comes in when you need to keep organized all of your expenses, all of your transactions, all of your business dealings, because that is how you translate this interest into a business.
Gotcha.
And that's one of my mantras is trying to teach people how to turn their hustles into a business.
Wow.
So until you have an infrastructure, until you have a business strategy, not a business plan, but a business strategy and some infrastructure blueprinted, you really don't have a business. You just have something that you just are interested in or something that you, what I say, throwing your money away into.
Wow, that was okay. And thank you so much, Momo. I see you just joined in, gave us the hearts. Keep on hearting it up, guys. We appreciate it. And that was so critical and key, especially for the people on the line who actually wholesale. I find that is a trap for a lot of wholesalers. They get, a check here, a check there, but there's no structure. And it's like, it's not a business. It's like a luxurious hustle that you're into, and you have no type of structure. So if something happens to you, then there goes your quote unquote business. So that's cool.
From a tax perspective, that's where a lot of people get in trouble, is when you start receiving large lump sums of money or a transaction here and a couple months later a transaction there, and you kind of lose track of that income. You kind of lose track of that money. You just took that money and you paid some bills with it. But at the end of the year, each one of those closing transactions, each one of those title companies is going to send you what they call a 1099.
Right.
That 1099 is a record of your income from that transaction.
Okay.
Now, if you don't have an infrastructure in place, if you don't have your stuff organized, you are not going to be able to keep track of your expenses that are associated with that income. And if you do not do that, you will have a tremendous amount of tax liability associated with that income that you made off of those transactions. So the more organized you can be, the more you look at your I don't want to call it hustle, but the more you look at your activities as a business, the better off you'll be in the long run.
Okay, cool. And then I see David Nett just joined the line. Thank you so much, David. David, where are you from? I never seen you on this line before. But anyway, so now in terms of valuable business solution, and let's say, because we usually have a couple of people like on the West Coast who join in. I don't know if we have anybody on Cali who's in on the line today. If so, make sure you put it in the comment box. But how does having an accountant on your team help you in terms of your business and that organization that you were talking about?
So that's not a typical question, but that's a typical question for somebody that's starting out in business.
Okay.
The problem with starting out in business is your funds are limited. Okay. So people try to do a tremendous amount of things themselves.
Right.
The problem with that is that you can't do everything.
Right.
All right. So what I try to tell people that are starting out in business, what I try to tell people starting out in real estate, build your team. Regardless if you have people on staff, you need to still build your infrastructure. So an accountant is a very integral part to your team. A lawyer is a very integral part to your team. Somebody doing administrative work is an integral part to your team. Somebody that's potentially doing marketing for you is an integral part to your team. These people don't have to work for you every day, but you need to be introduced to these people. You need to have them on a ring dial, because when you need questions answered, when you need things done, you need to be able to reach out to those people. Now, the importance of having an accountant is an accountant is going to keep you, hold you accountable.
Right.
An accountant is going to help you get organized. An accountant is going to sit you down and say, hey, does this make sense?
Right.
Okay, because anybody can make money, all right, but that's not a business. Okay, so when you have an accountant on your team, not only is it going to help you get your business organized, not only is it going to hold you accountable, whether you meet with them quarterly, monthly, and you're going to look at your operations in totality. It's going to help you organize your expenses. It's going to help you keep track of your income. And when it comes down to wholesaling, when it comes down to flipping, when it comes down to being a landlord, all of these transactions, all these activities are not one.
Right.
They're all isolated activities, isolated businesses.
Right.
So sometimes another issue or another problem that investors or real estate professionals run into is they try to mesh all of these activities into one pool.
Okay.
And when you do that, you can get yourself into some trouble because they all have their own special way of keeping track of those operations.
That's so cool. So now let's say this just came to my head and I see Jonas just joined in. Thank you so much, Jonas. So now let's say if someone is, wholesaling and flipping, what would be your suggestion? Like, should they be doing it under the same entity? Should they keep it separate? Like, how do they stop themselves from being messy?
The more organized you are, the less you have to do. Okay. So can you have under the same entity? Yes. All right, yes, you can wholesale and you can flip under the same entity. It's just that when you flip, that transaction, that project is not closed until the property is sold.
Right.
Okay. And similar to wholesaling, but you can have multiple wholesaling things going on at one time. You can kind of mix that into one activity, because when you get the check, that's when the deal is closed. So that's your sale.
Right.
Okay. And then that sale is your recorded income. On a flip, you can't record the expenses on that purchase or any expenses involved in rehabbing that property until the property is sold. So if you don't separate those activities, you are going to mix expenses from your flipping activities in with the expenses from your wholesaling, and then when you go and sell that property, you're not going to have any expenses to go against that property, and then your capital gains is going to be a lot higher. Okay, so you have to keep everything separated and segregated when you're dealing with real estate.
Gotcha.
Even when you have multiple flips going on at one time, you don't want to just mix all construction, all materials into one pool. You want to have them isolated, because if you have one property that's a lot less expensive than another property, but you move too many expenses onto a less expensive property, then your capital gains on that transaction is going to be a lot less. And then when you need the expenses associated with a certain transaction, going to be a lot higher.
Gotcha.
So keeping track of your expenses and keeping your projects separate is the most important thing. But no, they can be all ran under the same entity. It's just that you have to keep your projects separate.
I didn't even know that part. I hope I'm not the only, like, if somebody else knew that on the line, and tell me, but I'm pretty sure, like, you guys are behind the camera, so you're not gonna keep it straight up with me if you didn't know that or not. It's cool. So now you brought up capital gains. So I know, like, if you're in the 25 to 35% tax bracket, and for those people on the line who don't even know what tax bracket is, or they don't even know what tax bracket they fall in, like, is that just that standard average middle class tax bracket, 25 to 35%?
33 and up, you're pretty much in the millionaire tax bracket. So a lot of people aren't in that tax bracket. If you do have the luxury to be in that tax bracket, you know, that's a different conversation. Most people are between the 20 and 25% aggregate on their income. Just like we talked about before, if you don't keep track of your expenses, okay, and you're just going to receive 1099s at the end of the year from all of your dealings, whether you're doing a wholesale or whether you're doing a flip, okay, you can run the risk of pushing yourself into a higher tax bracket because you don't have the necessary expenses to drive that income down.
Oh,
okay?
Gotcha.
And then most real estate investors, most flippers, most wholesalers, they have another source of employment. And this is where the problems run into play. Most of the time, if you're just dealing with wholesaling or flipping and you're a beginner, your income isn't going to push you into many higher tax brackets. You're not going to have these big windfalls of great gains on your transactions.
Right.
But when you have another source of income, especially your primary employment, having additional chunks of income, $5,000, $10,000, $20,000, will push you up in a higher tax bracket. So if you don't have expenses associated with that revenue, then you can be in pretty bad shape come tax time.
So what would you say is like the average capital gains, and then how 15%. Can you 15%?
15 to 20%. Short term, it's going to be 20. Well, short term is going to be taxed at your normal income tax rate. Okay. So if you do a flip in less than a year, that's going to be a short term capital gains transaction.
Gotcha.
But if you push your transaction or your flip to over a year, okay, that's going to be a long-term capital gains transaction, and that's going to be taxed at 15%.
Okay.
So it's not combined with your normal income. That's going to be taxed in a separate transaction.
Oh, gotcha. Okay, cool. So now, what's like the best remedy? Because 15% to me, I don't know if anybody has a calculator out, but if you're doing like, you know, these wholesale deals, or you're flipping, let's say you're flipping a property, because this is more important for you guys. If you're flipping a property and you're making like $30,000 profit, and then you're getting taxed 15% on that, how can you kind of mitigate that? Because that's actually a large chunk there.
50% on a profit is actually less than your normal income tax rate.
Okay.
Because your normal income is going to be taxed between, like I said, 20 and 25%.
Ah, okay.
So actually the capital gains rate is actually helpful. That's why a lot of people say that Bill Gates, Donald Trump, they get taxed less than their employees.
Right.
That's because they're getting capital gains income long term versus their employees, which are getting W-2 income. So that gets taxed at normal income tax rates.
Okay. Yeah. So 1099 income. Okay.
Nope. Don't confuse 1099 income with income that could be associated with a capital gains transaction. Okay. The 1099 is just a reporting entity. How you flow that income is up to you. Because you get a 1099, that doesn't mean that you had a capital gains transaction. Capital gains transaction is only in the sale of assets.
Gotcha. Okay.
Long-term and short-term assets.
Gotcha.
All right. But you can get a 1099 for just being an independent contractor.
Okay.
Okay. And that had nothing to do with association and selling of a property.
Gotcha. Okay, makes more sense. And I see Diana just came in from Russia. Hey, Diana from Russia. How are you?
International.
Yeah, we get some international people from time to time. And, you know, Diana, and for all those who joined in a little later, I saw Cashflow Queen joined in, Cashflow Queen 50, I believe it was. Hey, girl. All right, so for those of you who don't know, we're the Real Deal Meetup. We're the third largest real estate meetup in the nation. And if you go onto therealdealmeetup.com after this, you can learn some more information about us. But Trevor White is the CEO of VBS, and he's going over, you know, some strategic ways in terms of how you can possibly even save on your taxes. You going to give us those details on how we could save?
You we get a little appointment.
All right, whatever. It's cool. No hurt feelings. So now, what are really the benefits? Because you went into it a little, like if you're keeping a property for over a year, so that typically falls into like the landlord area of life. So what are the benefits of being a landlord tax wise compared to making like a big lump sum being a flipper or a wholesaler?
Well, that really comes into, now we're getting into business strategy versus, you know, a tax strategy.
Okay.
The benefits of holding property, it could be a tremendous amount of benefit. You could be holding a property for over a year just because you don't want to trigger short-term capital gains. You could be holding a property because the appreciation value in a certain neighborhood is going up due to gentrification, or there's a larger capital project going on a block away. But in terms of what's better, that falls into, from a tax strategy, that depends on what your situation is.
Gotcha.
Do you have another source of income? How many properties are you looking to hold? What is the cash flow positive on that specific property? Does it make sense to hold that property, or does it make sense to just repair it and flip it?
Gotcha.
Okay? Some people don't have the luxury to hold on to a property. Do they have a mortgage on a property? Did they buy the property with cash? So these are all things that plug into that equation. So it's a more of a difficult question to answer than just saying what's the best scenario. But for landlords, the benefits of holding property there are a lot of deductions that are associated with being a landlord, okay, and also holding a property. So all of the income that's associated with that property, you get taxed on, okay. But also all of the expenses, even if that property is not occupied, okay, you still have carrying costs of that property, or all deductions. The cost of that property you can depreciate over 27 and a half years. Okay. All right. That's a what I call a non-cash deduction that you're always going to get. Okay. The property taxes on that property are deductible.
Oh, wow. Okay.
So even people that are holding property as rental properties, but they're not occupied, they're still going to get the deductions for the property tax. They're still going to get the deductions for the depreciation on that property. They're still going to get a deduction for any repairs or activities that driving back and forth to that property, if they're in the act of trying to rent that property out, their cell phone is now going to be deductible. So there are some benefits with holding on to property that is not necessarily occupied, but you still get deductions on that property even before it gets occupied, and even before you have tenants. Okay. On a flip deal, okay, that property doesn't necessarily become active as something that you can deduct, or the income isn't activated until that property gets sold. Gotcha. Okay, so none of the activities that are going on with that flip are reportable until the property is sold. Unless you have a separate company, okay, that is a construction company or a management company, and you're managing the activities of that transaction. So that way, if this is a long-term flip, you can still have some reportable expenses on that transaction before that property is sold. Okay, but you can't double dip. You can't have your management expenses also be triggered once you go ahead and sell that property, and now you want to expense for the same deductions that you took as a management company or as a contractor that was overseeing the flip. Oh man, we can't double dip. Okay, no, you can't double dip. Okay. Well, it depends on who you are, but this is why it comes into play of being more organized. Because the more organized you are, the less trouble you're going to get yourself into. Gotcha. Okay, because some people do things just by mistake, just by share from the fact that they just are not organized. So they may not realize, oh, well, I had this management company that was overseeing this flip, and I'm going to take the expenses for my cell phone because I was overseeing that flip on a daily basis. I'm going to take my mileage because I was overseeing that flip. Gotcha. And then when they go ahead and record the sale, and they're trying to build up all the expenses to go against that sale, including the purchase, all right, including the mortgage payments if you have a mortgage, the interest payments on that property, and then they're also going to include their cell phone and their mileage for managing that. No, that's not included anymore. Wow. Okay. Yeah. Man, I've been doing it wrong, just to let you know.
Before I met you, I was doing it like completely wrong. I had everything meshed in together. For people who use like Excel spreadsheets and stuff, like I was just putting everything together inside of the Excel spreadsheet, and I was like, yeah, this is all I'm doing, a fix and flip, I'm being a property manager, and just including it all in one. But that's why you need an accountant on your team, so you don't get in trouble with Big Brother. Not Big Brother Realty, who's on the line. I saw you a different person. So now this is cool. So let's say we have a scenario. My name is Tony. Tony owns a property in Baltimore City, and Tony is doing the renovations on it. He's gonna hold that property. Let's say Tony also works a full-time job with the state government, making roughly around $50,000 a year. So what would be Tony's best scenario, since he has an apartment that he rents? He is going to be a landlord at another property in Baltimore City, and he works full time, and he's going to be making $1,100 a month from his rental property. What would you say the best case scenario for Tony would be in terms of capital gains?
Well, there is no capital gains with this transaction.
Okay.
This is just regular income that's associated with a rental property.
Gotcha.
All right. So rental property income just flows through on your tax return, and it gets taxed at normal income tax rates.
Okay.
All right. So Tony's biggest situation, he's going to have to keep track of all of the income and expenses associated with that rental property.
Gotcha.
So on a basic spreadsheet, he's going to put his property address, he's going to put January through December, each have a column, and then each have a row, then on the each have a column, then on the row side he's going to have income, then he's going to have deductions. On the deductions he's going to have repairs, he's going to have utility costs, he's going to have taxes, he's also going to have mortgage interest, expenses if he pays for those, and then as every month goes on, he's going to record his income from that month, and he's going to record his associated expenses. This way, at the end of the year, when he comes in to see his tax preparer, he's going to give him that spreadsheet. The taxpayer is going to be able to say, okay, this is how much income we received for the year. If he had any property management expenses, if he had any tenant placement or tenant cost, whether he had to pay to put an ad up or he took an ad out in the newspaper. All of these expenses are associated with it. If he was advertising his property, any advertising costs also are associated expenses that he can put against the rental income for that year. So at the end of the year, we take the income minus the expenses, and then that's his reportable income or losses associated with that rental property. The beauty of the rental property scenario is that Tony's also going to get depreciation on that property, so he's not going to have to put any more money out of pocket. Okay. So whatever he paid for that property, any repairs he put in that property, that is what's called your basis in that property. That basis gets deducted over 27.5 years. So he's always going to have a line item for depreciation. You don't have to worry about calculating it. It's automatically going to get calculated. Well, make sure your tax preparer is calculating for depreciation on your property. And then he's also going to get a deduction for the taxes paid on that property. So those are two things that sometimes people overlook because it's not coming directly associated with a monthly transaction. All right, but remember to report your taxes paid on that property, and also remember to record your depreciation on that property. And even if you inherited that property, even if you took over that property, even if that property used to be your primary residence, and you didn't repay for it, okay, once you turn that property into a rental property, you can appreciate the value of that property over 27.5 years.
That's so cool. So I mean, like, what can't you write off? Like it sounds like you can write.
Like you gotta schedule an appointment.
No, the people want to know. Look, come on, guys, you gotta give them some heart so he can tell us what we can't write off. Because I'm trying to write everything off, but I don't want to get in trouble.
Well, exactly. This is where people get into a lot of trouble, is they think that every time they go out to dinner they can write that off.
Yeah, you got the hearts flowing and they want to know.
Every time they buy their kids something, or their girlfriend or spouse something, they write that off. Every time they take a trip to California, Bahamas, Florida, they want to write that off as a business transaction.
Right.
If you're not savvy, all right, if you don't have a good relationship with an accountant or a tax preparer or a tax professional, you don't just want to go start making these deductions and conducting these kind of transactions.
So true.
Because when you sit down with me, I'm going to make sure you have the proper records. I'm going to make sure that we discuss the scenario behind these deductions.
Gotcha.
Okay, because they have to make sense. Because if for any reason you do get a letter from the IRS and they do want you to explain an expense, we want to be able to flip open our book and say, okay, yeah, this is when you went to Florida. These are the 3 people that you met with down there. These are the properties that you went to go visit when you were down there.
Right.
That's what made that a business trip. Not going out down there and opening up a real estate magazine, so now that's a business trip. No, we have to conduct business in order to qualify these transactions or these deductions as appropriate deductions. Keeping track of business deductions is not that difficult.
Right.
Okay? You just need to put yourself in a bubble. And that's what I said when it comes down to being organized and staying on top of your business. When you put yourself in a business, anything that you spend money on in association with that business is a reportable business deduction. Okay? I don't care how outlandish it is or how outlandish that sounds. If you're conducting business and you need to spend money on something, okay, that's a business deduction. Now, how you report that business deduction, that's what we have to sit down and meet about, because some deductions may need to be depreciated.
Gotcha.
Some deductions you can take right away.
Gotcha.
All right. Some deductions need to be explained more than others. But a lot of real estate professionals, a lot of investors, they're not taking advantage of their home office deduction. They're not taking of their communication. What was it called? Communication with their cell phone deduction.
Yeah.
Anything in their home that they utilize, for their business. If they have a fax line, if they have a telephone line, if they have cable associated with internet at the home, they're not taking advantage of that deduction. Wi-Fi, if they need a mobile Wi-Fi, anytime they buy a computer, anytime they buy any equipment associated with it, people aren't taking deductions for these things. Anytime you go visit or spec a property, you can write off that mileage.
Wow.
All right, not just when I'm having an appointment with somebody. When you're conducting your business, these are the times when, now, if you're conducting a business, you stop at the 7-Eleven, you go pick up a drink. No, that's not a deduction. Okay.
Okay.
But if you're going to a site and you have somebody cleaning your property and you wanted to buy them some refreshments while they're working, then yes, that is a business deduction.
Got it. Okay.
So it's all about the way you categorize and the way you look at it.
Got it. All right, cool. So I'm gonna go take off that stop I made at 7-Eleven earlier off of my because all right, awesome. Well, I mean, you really dug into a lot of areas that I wasn't even too certain about, so that's gonna help out for a lot of people, and I pray that this was definitely helpful for all of you who were kind of, putting the gum and the tape together in terms of your taxes and your business. Like, let's not gum and tape this thing. This is serious business. If you plan on actually being a long-term investor, you need an accountant on your team. So, hey, quick question. If they want to actually get in contact with you, what's the best way for them to do that?
They can email me. My email address is T as in Trevor, white as in the color, at VBS, V as in Victor, B as in boy, S as in Sam, accounting.com. Or you can go straight to my website, www.vbsaccounting.com. Okay,
cool. And then we also do have one last question. So someone asks, can you speak on the benefits of using an association that's being taxed as a LLC? Hey, B Stern, I believe I got that right. Tony, can you clarify that question again for me, just to make sure that Trevor answers it correctly before we sign off? So if you have an association,
I don't know what that means. What do you mean an association?
Hold on.
You can't have an association.
Okay. So I believe he's speaking to the benefits of actually having an LLC for tax purposes. And if we're incorrect, Tony, okay, cool. Wanted to know if you would use an association as a tax shelter.
Well, let's just say he's trying to say, would you use an LLC as a tax shelter? Okay. The benefit of having an LLC when you're doing it by yourself is for liability protection.
Right.
Okay, that's the benefit. The primary benefit of an individual owning an LLC, what they call a single member LLC.
Mm-hmm.
The tax consequence of anything that happens with that LLC is no different than having a sole proprietorship, which is the same thing your own personal self having a business.
Oh.
The difference is that with an LLC, the transactions or any business endeavors that take place in that LLC cannot attack you personally.
Gotcha. Okay.
But when you do something as a sole proprietorship, if you get a lawsuit, someone can come after you personally. Okay?
Gotcha.
They come after your personal assets. But if they sue the LLC, they can only come after the assets inside the LLC.
Okay.
Okay. Now, if you want to start talking about corporations and S corps, that's a little bit more. That's a little bit more of a discussion in terms of taxes. But in terms of an LLC,
Mm-hmm.
a single member LLC, there's no true, tax deductions that you can't take, just by being a sole proprietor.
Okay, gotcha. So do you think it's better to have like more than a single member LLC since it's pretty much...
No. In order to have more than a single member LLC, you have to have partners, okay? That just makes it a LLC that's seen as a partnership.
Gotcha.
Okay? But no, having an LLC is good because that's taking your business a step further,
Mm-hmm.
okay? And I think that's what more business people need to do. All right, they need to incorporate their business. Okay, they need to become an LLC. They need to start operating an LLC, with a bank account. They need to get an EIN number from the federal government, because now it starts feeling real.
Right.
Okay.
Right.
Now, not everybody has to do that. Okay, but just from a standpoint of getting focused and saying, okay, I'm getting serious about this.
Mm-hmm.
Yes, go ahead and incorporate with your state and become an LLC. All right, and then go ahead and get a bank account under that LLC name. All right, start conducting business under that LLC name. Okay, and then you just keep track of all of your business transactions under that LLC. But you can do the same thing as operating as a sole proprietor. Okay,
Gotcha.
Just make sure you get insurance.
Oh, didn't know that.
Okay.
That's my last tidbit for you guys. So if you didn't have a question, you can go ahead and contact Trevor. This replay is actually going to be available for a bit. So if you missed anything, just make sure that you go back and replay the episode. On behalf of the Real Deal community and Charles Wood, the mad scientist himself, thank you guys so much for joining in. Thank you guys for the last minute hearts. Make sure you tune in actually next week, Thursday at 12 p.m. because I have a super duper special guest who is going to be on that episode. And thank you so much, Chameleon, for joining in late. What happened? All right, love you guys. Tune in out. See you next week.